as we get older, it's not uncommon to find yourself with the majority of your money in pre-tax accounts. Accounts like a regular 401k, a regular IRA, a regular 403b. And so why is that a problem? It's a challenge because every dollar that you take out in retirement, if all of your money is in these pre-tax accounts, every dollar is going to be taxable. There's a joke in my industry, it's not that funny, but every time you buy a loaf of bread from the grocery store, every time you fill your car up with gas, you've got to pay income tax on that. And it illustrates what the challenge is. So what can you do? I've been a financial advisor for over 20 years. I've helped hundreds of folks think through issues like this as they prepare to retire. And the first thing is, do not beat yourself up. The hard thing is to save the money. So congratulations on having been able to save the money. But you definitely want to plan ahead, because by planning ahead, you can save yourself thousands of dollars in taxes that otherwise you don't need to spend. And for some folks, it can be tens of thousands of dollars and even hundreds of thousands of dollars. Where it really kicks in is later, once you have to start doing required minimum distributions. But we're going to get into that later. The challenge for many of us that are in our 50s or early 60s or even our 40s is the Roth version of these savings accounts really didn't come out till 2006. So until then, we only had two choices: a taxable account or a tax-deferred account. And a tax-deferred account offers a lot of benefits. Now we have a third tool, which is the Roth. So high level, what I'm going to be talking about is how can, given that these dollars are going to get taxed, how can we get taxed at the 0% tax bracket? The U.S. has 7 official tax brackets. And really, I call it 8 because one of them is 0. Because up to a certain point, you only start getting taxed above the standard deduction, which for people that are married filing jointly, 2024 is going to be $29,200. But the 7 official tax brackets above 0 are 10% and then 12%. Then the next dollar, once you get over 12%, does not get taxed at 14 or 13%. It jumps all the way up to 22%. Then there's a 24% tax bracket. Then there's another big jump to 32%, 35%, and finally 37%. So for most of us, if we can get our money out of these tax-deferred accounts at the 10 and 12% tax bracket, we've won. And that's what we're going to talk about. But before I go there, I also need to share that there's another gotcha. And that is, because the money that we take out of our accounts is taxable income, it impacts our adjusted gross income, our AGI. It can potentially also trigger what's called IRMA. And IRMA is income related monthly adjustment amount, and it has to do with Medicare. We have to pay above certain amounts of AGI. We have to pay a premium for our Medicare Part B as in boy and D as in drug. And there's an increase on that. And if it's fairly low, so for an individual, they can make up to $103,000. And for married filing jointly, you can make up to $206,000. You may be thinking, I'm never going to hit that. But unfortunately, you very well may if you've got close to $1 million in your regular IRAs, your regular 401ks. You might, once required minimum distributions come in, and that, it starts off the premium starts off fairly, it's not modest, but fairly low, but it goes up to almost a $600 per month premium that you have to pay in addition to what you otherwise would have to pay. So it's definitely worth paying attention to, and you can find out more by just Googling IRMA, IRMAA. Again, that stands for Income Related Monthly Adjustment Amount. That and irs.gov, which is the official IRS website. So what can we do? Well, the first thing that you can do is you can think about, for sure, if in your early years of retirement you don't have a lot of income coming in, think about filling in, what I call filling in, that 0%, the 10%, and the 12% tax bracket. Now that can be complicated to do, and nothing I'm sharing here is financial advice. I would encourage you to work with an accountant or a financial advisor that's a fiduciary to you 100% of the time. So that's the first thing. And it may sound counterintuitive, but early in your retirement, if you've got these balances in your account, it may make sense to actually spend more out of these accounts if you have access to that 10% and that 12% tax bracket if you're below that. And even if you don't need the money, maybe you pull it out and you put it in a taxable account. So you're putting yourself in a position where your required minimum distributions later in life are lower. Again, you want to talk to an accountant or a financial advisor. Another thing you can think about doing is doing Roth conversions. Now you want to be careful. Sometimes people overdo Roth conversions, but there are ways to convert a regular IRA into the Roth version of it. And again, if you can do that and pay tax at the 10 or 12% tax bracket, probably makes sense to do that. If you do that and you're going to be paying tax at the 24, the 32% or higher bracket, may not make sense. So again, work with an accountant or an advisor. Another thing that a lot of folks don't know that they can do is there's something called a qualified charitable distribution from your regular IRAs that once you're over 70 and a half, you can start taking out. And as of 2024, you can take a single person can take $105,000 out and have that donated directly to charity. Now, you only want to do that if you're charitably inclined, and you don't have to take all of that out. But let's say you give a couple $1,000s a year to charity. Once you're over 70 and a half, you can take that, you can send that directly from your IRA to that charity. To find out more about that, you want to look up Qualified Charitable Distributions, QCDs, and IRS.gov. And the IRS has great papers on this explaining how that's done. And if you're, I said earlier, you have to be over 70 and a half, but if you're over 73, you can count that towards your required minimum distributions. So you can do that Roth conversion, you can do the qualified charitable distribution. Basically, the game plan is you want to get as much money as you can out of these accounts at as low of a tax bracket as you can. Again, it can save you thousands of dollars in taxes, tens of thousands of dollars for many people, and potentially hundreds of thousands of dollars if you have sizable accounts. So people forget when they look at retirement that taxes are likely going to be one of your largest expenses in retirement. So the tax side of it is critically important, and that's why before you retire, in early retirement or even late in retirement, it makes a lot of sense to work with an accountant or a fee-only financial advisor. I also think it makes sense to think about what your income's going to be in retirement and how does that compare. And that's why I made this video here. Let me point with my finger. That's why I made this video up here. Average income in retirement for the U.S. Made that video. I think you're going to find it super interesting. Many of my viewers, you're doing a lot better than you think. So average income in retirement. Thanks for watching this video, and I'll see you in that one. Bye-bye.